After that report, I know you recently initiated coverage on Alphabet. Did it make you change your rating or your price target?
Well, we're maintaining our outperform rating, but we lowered our price target just a little bit from $240 to $220, partly because of slowdown, like you mentioned earlier in your comments, and YouTube growth. And so given that we've already seen quite a bit of run up this year to date, Google shares have outperformed S&P 500 and NASDAQ. Both Google and Meta are at de-rating risk. And we lowered our target multiple modestly, but actually our estimates didn't change in any meaningful way.
All right, didn't change in any meaningful way. I want to go back to that YouTube ad revenue. So it came in at $8.66 billion, higher year over year, but 3% below estimates. In your mind, how big of a miss was it really?
Well, it was a meaningful miss because investors, from my understanding, we're expecting about 16.5% to 17% year-over-year growth. Now, understood that the compares or the comps from last year were a little bit more difficult, but the industry checks that we have been hearing and what investors have been hearing have largely been positive because YouTube Shorts continues to do well. CPMs have been holding nicely, and they should have been benefiting from expected political spend. So the expectations may have run up a little bit hot into the print, and that's part of the reason why investors were disappointed.
All right, let's talk about the CapEx. The guidance for the current quarter is $12 billion. They spent about $12 billion last quarter. We just mentioned the huge year-over-year increase. Last quarter, it seemed like some people were rewarded for spending on their data centers and the CapEx spending. This time around, do you think Alphabet was actually hurt?
No, I don't think so. Actually, if we take first, let's stick on CapEx. Last quarter, what they had said was when CapEx came in at $12 billion, that they expected CapEx to progressively increase modestly at or above the Q1 levels. Now, there is some variability quarter by quarter, and they essentially reiterated that spend trajectory. So in the back half of this year, they expect at or above $12 billion CapEx spend. So it wasn't a huge deviation from what they'd said before.
But wait, Shweta, one thing. Here's a big deviation from what they said before. On the call, they said they even believe that hyperscaler build-outs are just getting to be too much, and there might just be too much capacity. So if even they believe it, why would you continue to spend at this level?
Because they also said that if they do not build into expected demand and build capacity, then the potential downside from missing out from not building is much higher than actually building this capacity ahead of time, because they will find use across their platform given the useful life of these servers. Okay. So they will have the application for it. And in order to not miss out on the AI trend and the potential demand, the downside for them arguably may be greater.
All right. One other thing they mentioned, possible margin pressure. They're looking to hire, do a number of other things, including CapEx spending. Is that meaningful for a stock like this that has so much AI potential? I mean, are you focused on their margins?
Absolutely. Actually, when we look at across the board on fundamentals, so let's take on margins, 32.4% operating margins are highest we have seen in at least 3 years, and then a decade prior to that. So they've not printed 32.5 or 32.4% in a long time. They have been, what they have said is they're durably re-engineering cost base, essentially reallocating resources, combining teams where they can see fit, and applying AI across their customer service platform so that they can save on costs. So it's certainly working. Now, the bigger question is, do we expect a headcount reduction? They've not done as big of a reduction as we've seen at Meta, for example, and that's to be seen. My best guess is that with a new CFO coming on board end of this month, it may be a bit too premature for her to make such an aggressive move straight off the bat. So maybe it's a 2025 or beyond initiative, but that remains an option value for this company.